David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. Today I'm joined by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about how the election could impact the economy and the market. David, this is a big topic, and I'm sure our viewers look forward to what you have to tell us about it.
As you might imagine, one of the most often asked questions that I have received from clients is, who will win the election and what impact do you think that will have on the market? Clearly, I am without a crystal ball. And as the previous election reminds us, trying to outguess the sentiment of voters can be a dicey proposition. As I've mentioned before, historically, the markets really don't care who occupies the White House. The markets are neither Republican nor Democrat. Markets are driven by certainty, and they just want to know what the rules are. Clearly, those rules can change as a function of who occupies the White House. Also, it seems that in advance of every election, there is a mindset of how this one will be the one that shapes the world forever. I would caution everyone to temper such thoughts. Elections are a normal part of our life, and the markets have always adjusted to those outcomes. Having said that, however, I do believe that this election will have an impact on the economy and by extension the market as well. Today, I simply want to observe some quantifiable fact as it pertains only to matters of economic concern. This should not be construed as a referendum on social issues or other factors that can, and often do, shape an individual's motivation for voting. We don't have a tremendous amount of time in this video, so I would like to focus on four main areas. First, we will focus on what we know about the difference in tax policy between the two candidates. And in the process, we will take a look back to when we saw a similar approach to taxation and economic policy. Secondly, we will evaluate how that tax policy impacted the economy in terms of consumerism and as evidenced by the velocity of money. Third, we will take a look at the differences in economic policy and how that shaped consumer behavior in terms of increases to income and the behavior of corporations with regard to decisions made with cash reserves. Lastly, we will take a look at the stock and the bond markets themselves to see if we can glean any insight as to what the markets may be telling us at this time. First, let's establish the difference in tax policy between these two candidates. You are looking at a graphic that appeared earlier this month in the Atlanta Journal-Constitution. Vice President Biden has often suggested that if elected, he would seek to repeal the Tax Cuts and Jobs Act. And he's also stated that rates of taxation on corporations and individuals would rise as a result. In my opinion, when additional dollars are taxed out of your pocket or from the pockets of corporations, then consumerism declines. If you think about it, this makes sense. If my tax liability rises, then I have fewer dollars to use for the purchase of goods and services. If I am not purchasing as many goods and services as I once was previously, then retailers are not stocking as many of those items on the shelf, and by extension, their vendors aren't making as many of those items. If vendors aren't making as many of those items, then they don't need the level of employment that they previously did, and layoffs often result when consumerism declines. It is a negative feedback loop. We can measure this by looking at the velocity of money. You are now looking at a definition from Investopedia that describes why it's important to understand the velocity of money. High velocity of money is usually associated with a healthy and expanding economy. Low velocity is usually associated with recessions and contractions. Under the previous administration, factors such as the Affordable Care Act, tighter EPA regulations, lending restrictions, and higher liabilities of corporate and personal taxation conspired to reduce the velocity of money. You are now looking at a graphic from the St. Louis Federal Reserve Bank that depicts the 8 consecutive years of decline in the velocity of money under the previous tax and economic policies of the former administration. If the velocity of money is declining, then by extension, we can expect to see that manifesting in slower increases of gross domestic product, or declines. You are now looking at a graphic that depicts the 8 years of the previous Obama-Biden administration. At no time did the previous administration observe annualized GDP growth of greater than 2.6%. Indeed, it was the only administration since before Theodore Roosevelt to not experience annualized growth of gross domestic product above 3%. As we have often noted in the past, corporations hoarded cash between the years of 2007 and 2016, as the previously mentioned issues incentivized companies to become increasingly defensive. Again, you are looking at a definition from Investopedia that describes why, in general, it's a bad thing to have increasingly larger positions of cash on balance sheets of corporations. Now you're looking at a graphic from the Federal Reserve Bank of St. Louis that depicts total cash on hand across companies within the manufacturing industry. Between the years of 2009 and 2017, the nominal value of dollars held in cash on corporate balance sheets increased significantly, and they remained elevated during the tenure of the Obama-Biden administration. Upon this graphic, you can see a similar pattern that reflects cash on hand across the balance sheets of corporations in the retail trade industry over the same period of time. The Tax Cuts and Jobs Act of 2017 incentivized those companies to begin spending cash at a much faster rate once the impediments were removed. Among other things, those impediments were penalties on repatriated dollars, higher corporate taxes, penalties and the uncertainties surrounding the Affordable Care Act, and lending restrictions under the Volcker Rule. You are now looking at a headline from the Wall Street Journal that appeared in June of 2019 from a story that described a significant drop in cash reserves on U.S. corporate balance sheets to what was at that time a 3-year low. Clearly, a significant change in the tax policy of one administration to the other can directly impact the behavior of corporations in terms of their willingness to spend money. As corporations spent money at a faster rate, we also observed a historically strong increase in the average annual growth of supervised wages. You are now looking at a graphic from the Federal Reserve Bank of St. Louis that depicts the period of time between October of 2018 through February of this year that reflects this trend. This is important because according to the Bureau of Labor and Statistics, 70% of all of those who earn a paycheck in this country are included in the supervised wages category. Beginning with October of 2018 and ending with February of this year, as the COVID-19 pandemic began, those in the supervised wages category saw their wages increase between 3.1% and 3.3% per year on a 1-year rolling annualized basis for 16 straight periods. These were the highest rates of annualized increase that we had observed in a decade. There are 120 rolling 1-year periods in a decade. As of February of this year, we had observed the best 16 out of the last 120 1-year rolling periods in a row for 70% of those who earn a paycheck in this country to observe their wages increase on an annualized basis. This overlays perfectly with the inception of the Tax Cuts and Jobs Act. We can also gauge the impact of faster corporate spending velocity by observing this graphic from the American Heritage Foundation. Under the 8 years of the Bush administration, real median household income increased by 0.7% per year. Under the 8 years of the Obama-Biden administration, real median household income increased by 1.7% per year. Under the 3 years of the Trump administration, following the inception of the Tax Cuts and Jobs Act, real median household income increased by a rate of 6.8% per year. This is the anticipated cause and effect relationship that I would expect from an economy gaining momentum and fueled by the rise in the velocity of money and incentivized by a favorable tax code. Clearly, real median household income rose by a much faster rate than at any other point over the previous decade and across 2 different administrations. Lastly, on this topic, you are now looking at a graphic from the Federal Reserve Bank of Atlanta that compares the construction and mining industry to the rate of growth of overall wages. It is the construction and mining part of the economy where we find the greatest concentration of supervised wages. To the far right of this graphic, you can see where these wages began to grow very sharply upon the inception of the Tax Cuts and Jobs Act, and how those wages have outperformed the rate of increase for overall wages through February of this year. Looking at these graphics, I believe that we can clearly discern that indeed the tax policy of the Trump administration incentivized faster economic growth than we had previously observed. And this translated into real household income and primarily concentrated in the area of supervised wages. Newly crafted trade agreements such as USMCA and improved international trade agreements with China and the nations of the Pacific Rim have also added momentum to our economic growth. It is important to recognize that Vice President Biden, on many occasions, has stated that he would seek to repeal the Tax Cuts and Jobs Act, as well as trade agreements that were revised under the Trump administration. We have already observed what the velocity of money looked like under the previous administration, and by extension, the growth of gross domestic product when we had a less favorable personal and corporate tax and trade structure. In my opinion, because markets are discounting mechanisms, it would stand to reason that if the bond market and the stock market believed that we were going back to the previous tax and economic approach of the Obama-Biden administration, then we would probably be able to observe that in market sentiment. You are now looking at a graphic of the TED spread. Now, we have discussed the importance of this metric within many previous videos. As of today, the TED spread stands at 14 basis points. A tight TED spread is viewed as the sentiment of the bond market being that good economic conditions exist and they are likely to continue through the foreseeable future. Please note the far left side of this graphic and observe that throughout the year of 2016, the TED spread gradually increased from 20 basis points to 70 basis points. The bond market was signaling that economic conditions would likely remain stagnant. Following the surprise result of the 2016 election, however, the TED spread tightened as those economic assumptions were repriced. When I look at this graphic, in my opinion, if the bond market thought that we were less than 2 weeks away from a dramatic change in tax and economic policy to something more closely aligned with the previous administration, then you would expect to see a response in the TED spread drifting higher as we did throughout 2016. You are now looking at a graphic of the Standard & Poor's 500 index. Again, we have long ago established that the markets are discounting mechanisms. Recently, Goldman Sachs increased their third quarter GDP forecast from 19% to 35%. Throughout the year, we have heard Treasury Secretary Mnuchin and Larry Kudlow, among other economists, suggesting that gross domestic product in the fourth quarter and into next year could also be historically robust. The market seems to be pricing into itself the likelihood of increasingly higher revenues and earnings as a result. Again, based on what we have observed in this video, it is my opinion that if the stock market thought we would go back to an environment where the velocity of money was slow and disincentivized by less than favorable tax conditions and economic policies, then the stock market would likely be reflecting this and would probably not be near historically high values. Lastly, in recent weeks, many companies have reported that they are experiencing positive free cash flow. This is surprising given the short amount of time between today and the reopening of the economy. What is of even greater surprise, however, is the number of companies that are saying that they are using this positive free cash flow to increase payouts of dividends. As we have previously seen in this video, when faced with a less than favorable tax code under the previous administration, companies were incentivized to hoard cash, not spend or release it. So again, in my opinion, with less than 2 weeks to go before the election, if the prevailing sentiment of corporate America assumed a dramatic change in the approach to tax and economic policy, then the last thing I would expect to see is a pattern of taking positive free cash flow and sending it out the door in the form of higher dividend payments. So in summary, based on everything that we have observed in this video, it is my belief that neither the stock market nor the bond market, nor corporate America for that matter, seems to believe that we will have a change in current economic and tax policy, as evidenced by their behavior and quantifiable metrics. Read into that what you will, but I believe I have presented numbers with which there is no argument and trends that can be clearly observed. Having said that, remember that for most of you, investment objectives that are longer term in nature are in a position to survive the impending election result. Yes, it is possible that tactical changes may be necessary to long-term investment plans, but rarely does that mean the cessation of those plans. Remain true to your investment goals and take advantage of opportunities that the market provides to you as they come. Be mindful of quantifiable fact and insulate yourself from media sensationalism.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.